Good day, ladies and gentlemen. Welcome to my YouTube channel. I apologize for not being consistent and disappearing, but nonetheless, your girl is back. And as you can see by the topic, today we will be covering lump sum benefits. Let's get straight into it. Let's take a look at the learning outcomes. At the end of this tutorial, you need to be able to explain the principles of the taxation of lump sums on death, retirement, and or termination of office. You need to be able to recognize the different types of lump sums and to apply the legal principles to the taxation of those lump sums. You need to be able to calculate the taxable portion of a lump sum benefit received from a retirement fund upon retirement, retrenchment, or death, and upon withdrawal from the retirement fund. And lastly, I need you to be able to calculate the taxable portion of severance benefits received from employers. There are several specific inclusions in gross income that are applicable to individuals. And in this tutorial, we will deal with lump sums received. The net amount of lump sums received are included in gross income in terms of paragraph D, E, and F of the definition of gross income. However, the normal tax payable on lump sums is calculated at a different rate than other normal tax payable. What does this mean? This essentially means that lump sums will be calculated using different tax tables. The net amount is calculated in terms of the second schedule in the Income Tax Act. In terms of the second schedule, lump sum benefit includes any amount determined in respect of the commutation of an annuity or portion of an annuity, payable by or provided in consequence of membership or past membership of a pension fund, pension preservation fund, provident preservation fund, or retirement annuity fund, and any fixed or ascertainable amount other than an annuity, payable by or provided in consequence of membership or past membership of a pension fund, pension preservation fund, provident preservation fund, or retirement annuity fund, whether in one amount or in installments, but does not include any amounts deemed to be income accrued to a person in terms of Section 7, subsection 11, which is an anti-avoidance provision. If you are a third-year student or a second-year student, you don't need to worry about this for now. Retire in relation to a person who is a member of a pension fund, pension preservation fund, provident preservation fund, or retirement annuity fund means to become entitled to the annuity or lump sum benefit. When we say a taxpayer has retired, we essentially mean that the taxpayer has become entitled to the annuity or lump sum benefit which they have been making contributions towards over the past couple of years. So how do we navigate around this topic? The first thing you have to do is to identify the source of the lump sum benefit. Lump sums can either be from employers or from funds. If the question says the lump sum is from an employer, it will either be an ordinary lump sum, which will constitute gross income in terms of paragraph D of the gross income definition, or it will constitute a severance benefit. And if the lump sum benefit is from a fund, it will either be a retirement lump sum benefit or a withdrawal lump sum benefit. So as soon as you get a question, you have to establish the source of the lump sum. If it's from an employer, it will either be an ordinary lump sum or a severance benefit. And if it's from a fund, it will either constitute a retirement lump sum benefit or a withdrawal lump sum benefit. Now let's take a look at the lump sums from employers. As I've already mentioned, lump sums from employers can either be ordinary lump sums or severance benefits. Now, how do you know if it's an ordinary lump sum? Ordinary lump sums constitute ordinary taxable income and will be taxed in accordance to the sliding scale for natural taxpayers. So the lump sum will be included in gross income in terms of paragraph D of the gross income definition. And how do you know if it's a severance benefit? Severance benefits are paid in respect of loss or termination of office or employment. The following requirements must be met. The taxpayer must be at least 55 years old, or the taxpayer must be permanently incapable of performing work duties due to sickness or injury, or the employer must have ceased trading or reduced staff. So in addition to the loss or termination of office, the following requirements must be met. Taxpayer must be at least 55 years old. Taxpayer must be permanently incapable of working, or the employer must have had a general staff reduction. Now, if any of these requirements are met, then the lump sum from the employer will constitute a severance benefit and will be taxed in accordance with the retirement annuity lump sum tax table. So severance benefits and retirement annuity lump sums will be taxed on the same tax table. Let's take a look at the lump sums from funds. So retirement annuity lump sums will be paid due to retirement, retrenchment, or death. My apologies. And withdrawal lump sums will be paid due to resignation or withdrawal from funds. And this is usually when the taxpayer elects to receive their funds prior to reaching the retirement age. Why is this information important? This information is important because you will not always be told whether it's a severance benefit or a retirement annuity lump sum or a withdrawal. Your lecturer will simply give you the characteristics of a severance benefit or a retirement annuity lump sum or a withdrawal. So you'll be given enough information to conclude on whether it's a severance, retirement, or withdrawal lump sum. Take note, the rules of a pension fund, pension preservation fund, and retirement annuity fund provide that not more than 1/3 of the total value of the retirement interest may be commuted for a single payment. What does this mean? This means that a taxpayer will only be entitled to 1/3 of the total value of the retirement interest. So the remainder of the retirement interest must be paid in the form of an annuity. So a certain portion, 1/3, to be precise, will be the lump sum, and 2/3 of the value of the retirement interest will be paid in the form of an annuity. So the remaining balance of the non-deductible contributions is then applied as an exemption against any qualifying annuity received by the taxpayer. Non-deductible contributions are the disallowed contributions in terms of Section 11F. And if there's any one of you that doesn't know what I'm talking about, please just let me know in the comment section. If after applying the Section 10C exemption for the annuity, a balance of non-deductible contributions remains, this balance can be considered actual retirement fund contributions, which can be claimed as a Section 11F deduction. Thereafter, any remaining balance is carried forward to the following year, where the balance can be applied in the same order, first as a deduction against the lump sum, and then as a Section 10C exemption, and lastly as a Section 11F deduction. So refer to Chapter 9 for a detailed discussion in this regard. There's an example in Chapter 9, I think it's example 5.5, I'll just double check for you and I will put it in the comment section so that you can go have a look at what I'm talking about. In terms of the actual calculation of the tax payable on lump sums, I have put together a step-by-step procedure for you to follow. Step number one, you calculate the cumulative or aggregate lump sums received by the taxpayer to date, less deductions in terms of paragraph 5 and 6 in the second schedule. Now, when I say cumulative or aggregate lump sums, I basically mean you add up the total lump sums that the taxpayer has received to date. So if, for example, the taxpayer has received a withdrawal lump sum 2 years ago, and in the current year of assessment, taxpayer has received a severance benefit or a retirement annuity lump sum, you add them up together. That's step number one. Less deductions in terms of paragraph 5 and 6. Please make reference to these deductions in the Income Tax Act or in your textbook. So one of the things that you're going to deduct in step one is disallowed contributions in terms of Section 11F. And you'll also deduct transfers from one fund to another. So that's just a few examples that I can think of. Step two, the most recent lump sum received or accrued must be used to determine which tax table to use. So if the most recent lump sum received was a severance, then you will use the retirement lump sum tax table. If it was a retirement, if the most recent lump sum received was a retirement annuity lump sum, then you also use the retirement lump sum tax table. But if the most recent lump sum received was a withdrawal, then you will use the withdrawal lump sum tax table to calculate the tax on the cumulative or aggregate lump sums received by the taxpayer to date. And I hope you guys are still following, right? Step three, you will calculate the hypothetical tax and deduct it from the cumulative tax payable. So the hypothetical tax is basically the tax on the previous lump sums received by the taxpayer. So if the previous lump sum received was a withdrawal, then you will calculate the withdrawal lump sum received previously by the taxpayer using the withdrawal lump sum table. Step four, the difference is the tax payable on the current lump sum received. So let's take a look at this example that I've put together. I don't remember where I got this example from, but I know I got it from some notes. So let's take a look at it. Fred Osborne is 60 years old and married in community property to Frances. They are both residents of the Republic. Fred is the sales manager at J&J Pharmaceuticals Limited and is responsible for 15 sales representatives at the company. Upon retirement on the 28th of February 2022, the pension fund paid Fred a lump sum of 3 million rand. This was in the 2022 year of assessment. He invested the amount on the Securities Exchange. When Fred turned 55 years on the 15th of October 2015, and this was a couple of years ago, all right? He retired a couple of years ago and he received his benefits from the retirement annuity fund. The total amount that accrued to him at that stage was 900,000 Rand, which is 1/3 of the total value of the fund. Of this amount, he took 300,000 Rand and transferred 600,000 Rand into his bond account over his house. The retirement age from the retirement annuity fund, according to the rules of the fund, is 55 years old. So taxpayer is over the age of 55 years old. All right. Now let's determine the source of his lump sums. So the first lump sum he received was in 2015 when he turned 55. And this was from a fund. This was from a retirement fund, right? A retirement annuity fund. It was amounting to 900,000 Rand, which was 1/3 of the total value, which means 2/3 of that was an annuity. All right. but this was in 2015. In the current year of assessment, on the 28th of February 2022, he received another 3 million rand from a pension fund. So now we have to calculate the tax payable on Fred's lump sum gain or loss for the 2022 year of assessment. So we have to calculate the tax on the 3 million lump sum that he has received in the current year of assessment. So step number one, let me just go back to the steps. Step number one is to calculate the cumulative or aggregate lump sums received by the taxpayer to date, less deductions in terms of paragraph 5 and 6. So the first lump sum was 900,000 Rand, and this was in 2015. The second lump sum was 3 million Rand that he received on the 28th of February 2022. So you calculate the cumulative or aggregate lump sums. And if you add them together, that should give you 3.9 million Rand. However, in this particular examples, we don't have any deductions in terms of paragraph 5 and 6. So as you can see, cumulative lump sums, that's 900,000 Rand plus 3 million, and that gives you 3.9, less deductions or unclaimed balance of contributions disallowed. In this example, we don't have any deductions or unclaimed balance of contributions disallowed in terms of section 11F. Step 2 is to calculate the tax on the, so step 2 is to use the most recent lump sum received to determine which tax table to use. So the most recent one was the 3 million Rand, and it was from a pension fund, and he's over the age of 55. So that was a retirement lump sum, right? So now we know we have to use the retirement lump sum tax table to calculate the tax on the 3.9 million. So that's what you do. Tax per retirement fund tax table, that should give you 1,156,500 Rand. Step 3 is to calculate the tax on the hypothetical tax on the previous lump sum. The previous lump sum received by Fred was the 900,000 Rand, which he received in 2015. So now we have to calculate the hypothetical tax on that 900,000 Rand using the relevant tax table. So this was a retirement lump sum. If it were a withdrawal lump sum, we would calculate the tax on the 900,000 using the withdrawal tax table. However, it was paid to him upon retirement, so we will use the same table, which is the retirement annuity lump sum table. Now, when you calculate the tax on the hypothetical tax on the previous lump sum, that should give you 90,000 Rand. And step 4 is to calculate the tax payable on the lump sum received. So you basically deduct the hypothetical tax from the tax per retirement fund tax table, and the balance is 1,066,500 Rand. So that is the tax that is payable on the 3 million that Fred received in the current year of assessment. Thank you so much for watching. For those who don't